come to one of the most important aspects of financial markets, liquidity, or perhaps more precisely, lack of liquidity. This is extremely important when you're considering your trading positions and your ability to exit them. Liquidity is absolutely essential if you are to be able to efficiently get in and get out of markets. We of course have seen a serious liquidity crisis over the past couple of years in the credit markets, the so-called credit crunch. But as this list shows here, we have had some 12 similar crises or crashes, often linked to liquidity problems, in the last 20 or so years. So do not imagine that liquidity problems are a once-off in the credit markets. They have a habit of appearing across many different markets over time. It would be reasonable to be cautious in our attitudes towards liquidity and to assume that there will always be the chance of a problem in the future. This is essentially a wake-up call to anybody who is over-trading or is overexposed. It's always very important to take note of the fact that you should be able to exit your position as well as enter it. The main things to look out for in market liquidity are depth and breadth. By depth, I mean volume and the ability to be able to trade in good size in the marketplace. By breadth, I mean width of interest in the marketplace. Are there many holders? Is it a sector or an industry or a stock which is widely traded? Or is it something that is only traded in a narrow part of the day by a very small number of players? If a market has good depth and good breadth, you're likely to have very good liquidity. If there is a deficiency in either of those two elements, liquidity may be poor, and if you lack both depth and breadth, you could have a serious market liquidity problem. Poor liquidity is often illustrated by small bids and offers, people don't really want to commit themselves to trading, and wide spreads between the bid and the offer. Occasionally, markets seize up in that certain stocks there are no bids or offers, or in an extreme example, an entire market shuts down. The best example of that in the fairly recent past was the crash of 1987, where in fact the Hong Kong stock market shut down for 4 full trading days. Anybody with positions in Hong Kong stocks over those 4 days found themselves being like the poor lobster, stuck in the pot and couldn't get out. In addition to market liquidity, we need to pay careful attention to market volatility. Market volatility is simply the relative rate of change of a share price, a commodity, or a currency. Some financial instruments are inherently more volatile than others. Typically, shares in small companies or in emerging market currencies or any small market are more volatile than instruments in a large market. Market volatility is also linked to liquidity. If a market is fast moving and there's less liquidity, perhaps because of a piece of shock news, volatility tends to be higher. Volatility need not be a bad thing, but like lots of things in life, if there's too much, it can get very dangerous very quickly. The key thing with volatility is it affects your risk management strategy of your trading plan. If you're running stop losses or you're trying to monitor levels at which you start to feel pain on your portfolio, higher volatility stocks, currencies and commodities will make it harder to manage your position. So if you're in small markets with high volatility, you should seriously consider trading in smaller amounts, to take a conservative approach to limit any potential losses from sudden and unexpected moves. Some of the characteristics of market volatility show themselves around the topic of uncertainty. Markets hate uncertainty. It may be some shock news or a feeling that there is no certainty about a future outcome. Allied to volatility in those circumstances, we often see a decline in liquidity. So sharp volatility increases and liquidity decreases often go together. What are the consequences of this? We often get sharp and sudden price movements on very low volume because nobody is able to trade, and in extreme examples we can get panics and crashes. So both market liquidity and market volatility sit together as a couple of potentially very dangerous twins that you need to keep a careful eye on. Again, this is important in terms of risk management. If you are not monitoring the liquidity of the market you're in, and you're not monitoring the volatility of the market you're in, you're leaving yourself exposed to sudden and violent moves that may go against your trading position.